The market has taught traders one expensive lesson over and over again. Most people lose money, not because they know too little, but because they keep looking for more than they need. You think the answer is hidden in another indicator, another confirmation, another screen full of signals. You think complexity protects you. But what if complexity is the thing blinding you? Think about it for a moment. Why is it that traders can stare at 10 indicators and still hesitate when it's time to act? Why do they freeze at the exact moment they spent hours preparing for? Because too much information does not create confidence. It creates conflict. Now there is a strange thing about markets. The bigger the move, the cleaner it often looks in hindsight. Yet while it is unfolding, it rarely feels obvious. It feels uncertain. It feels uncomfortable. And that brings us to something simple. Something many traders overlook because of its simplicity. The 20 RSI Trend Strategy. Now before you focus on the name, understand the idea beneath it. Markets do not move because indicators say they should. Indicators simply reveal behavior. Human behavior. Crowd behavior. Fear and greed leaving footprints on a chart. RSI is one of those footprints. Most traders learn RSI in the same predictable way. They hear that 70 means overbought and 30 means oversold. So they immediately start hunting reversals. Price reaches 70, they sell. Price reaches 30, they buy. Then, they sit there confused, while the market keeps climbing against their short position or falling against their long one. Have you seen that happen? Maybe you have watched price become more overbought after you sold it. Maybe you felt the frustration of seeing a market ignore what you thought was a rule. But the market wasn't breaking rules. You were reading the situation backward. Strong trends stay strong. Weak trends stay weak. That sounds obvious when you say it out loud, but trading becomes difficult because the mind naturally wants bargains. People walk into stores looking for discounts, and then they walk into markets with the same habit. Price looks high. They think it should come down. Price looks cheap. They think it should go up. The market doesn't care what looks expensive to you. The market cares where pressure exists, and pressure leaves evidence. So let us observe something. In strong uptrends, RSI often refuses to return to deeply oversold areas. Instead, it finds support around the middle zone and pushes higher again. In strong downtrends, the opposite happens. Now, why does that matter? Because it changes your role completely. Instead of becoming a trader who fights movement, you become a trader who joins movement. That sounds simple, but psychologically it is not. Because buying strength feels uncomfortable, selling weakness feels uncomfortable. You see a market already moving and your mind says, I missed it. But did you? That question matters more than people realize, because trends are not single events. Trends are ongoing behavior. Think about a train leaving a station. Most traders stand there watching the train start moving and panic. It's gone. Then they run after it recklessly. Or worse, they stand there expecting it to reverse and come back. But experienced traders understand something different. The beginning of movement is not always the opportunity. The continuation often is. Now let us bring this into practical terms. Suppose you are looking at a chart and price is trading above a rising moving average. Price is making higher highs and higher lows. The structure itself is healthy. Now watch RSI, not for extremes. Watch behavior. Does RSI pull back toward the middle area and stabilize? Does price pause instead of collapsing? Does buying pressure quietly return? Notice what is happening there. Momentum is cooling without trend structure breaking. There is a difference, a very important difference, because exhausted momentum and broken structure are not the same thing. Many traders confuse the two. A runner slows down to breathe. That does not mean the runner has quit the race. Markets behave similarly. You want to see controlled pauses inside strong movement. You want to see moments where emotional traders become uncertain while stronger hands remain involved. Why? Because uncertainty creates opportunity. The impatient trader sees slowing price and becomes nervous. The trend trader sees slowing price and becomes attentive. Same chart, different eyes. Now there is another part people rarely discuss. What should you avoid? Because sometimes what you ignore matters more than what you chase. Avoid forcing trades when price and momentum disagree in messy ways. Avoid entering because RSI touched a number without understanding context, and avoid one dangerous habit above all: do not predict. Prediction gives the mind false authority. Observation gives the mind discipline. There is a difference. Prediction says, price will go here. An observation says, price is behaving this way. The one creates ego. The other creates flexibility. Have you noticed how many traders become attached to being right? They stop managing risk because they become emotionally committed to an idea. Then the market starts speaking differently, and they refuse to listen. The market whispers before it shouts. First momentum shifts, then structure weakens, then price follows. But traders who are busy defending opinions usually miss the early signs. Now consider the 20 RSI Trend Strategy from a practical point of view. You are not asking RSI to predict the future. You are asking it to reveal pressure. You are asking it one simple question: who still controls this market? Because trends continue for one reason: control remains on one side. And when control remains, pullbacks often become invitations rather than warnings. You watch price behavior. You watch momentum behavior. You wait for alignment. Not excitement, not urgency. Alignment. Because when structure and momentum begin speaking the same language, something interesting starts happening. And once you learn to recognize that conversation, you start noticing that certain moves no longer look random. You begin seeing why inexperienced traders panic at the exact moments experienced traders become interested. You begin understanding why the market often rewards patience before action. And then another question appears. A dangerous question if misunderstood. How long should you stay in a trend once you are already inside it? Most people think the answer is obvious. It isn't. One of the biggest mistakes traders make with RSI is expecting it to tell the future. They treat it like a crystal ball. They wait for a number to appear, and the moment it does, they believe the market has already given its decision. RSI reaches 70, so they assume price must fall. RSI reaches 30, so they assume price must rise. The thinking becomes automatic, no questions asked. But markets do not work that way. RSI is not a prediction machine. It was never designed to predict where price will go next. It reads behavior. It measures the speed and strength behind price movement. That difference may sound small, but in trading, small misunderstandings become expensive habits. Think about people in everyday life. If you walk into a crowded room and everyone suddenly turns toward one side, you immediately know something is pulling attention there. You may not know what will happen next, but you recognize movement, focus, and energy. Markets behave in a similar way. RSI is not telling you the future event. It is showing you where attention and pressure currently exist. Now ask yourself something. How many traders see RSI moving into overbought territory and immediately prepare for a reversal? Most do. They assume the market has gone too far. But what are they really seeing? They are seeing strong buying pressure. That pressure itself is information. The mistake happens because people interpret strength as weakness. In a healthy uptrend, strong buying pressure can remain for longer than most traders expect. Price can continue climbing while RSI stays elevated. The trader waiting for an immediate reversal becomes frustrated because the market keeps moving against the idea in their mind. The indicator was not wrong. The interpretation was wrong. This is where behavior matters. If RSI rises aggressively, it tells you buyers are active. If RSI begins losing strength while price continues climbing, now you are observing a change in behavior. Notice the difference. One situation measures participation. The other starts revealing possible weakness. Good traders pay attention to these shifts because markets often change character before they change direction. That is why staring at a single RSI number without context creates problems. Numbers alone do not tell stories. Behavior tells stories. Pressure tells stories. The relationship between price movement and momentum tells stories. You are not asking RSI to predict tomorrow. You are asking it to reveal who is acting today. One of the habits traders bring into the market comes from everyday life. People naturally look for discounts. They walk into a store and feel good buying something after the price drops. They wait for sales, lower prices, and bargains. In normal life, that way of thinking often makes sense. Then they enter the market carrying the exact same mindset. Price rises sharply, and they immediately think it has become too expensive. Price falls heavily, and they begin thinking they have found value. The instinct appears almost automatically. Human beings like the feeling of buying low and selling high because it sounds logical and comfortable. But markets have a strange way of challenging comfortable thinking. Strong trends rarely become cheap when you want them to. Think about it carefully. Have you ever watched a market move higher day after day while waiting for the perfect pullback? You tell yourself you are being patient. You tell yourself price needs to come back before you enter. Then the market pauses briefly, moves higher again, and suddenly you are standing outside watching a move that continues without you. The market does not pause simply because someone thinks it should. When demand becomes strong enough, price can continue moving while leaving many traders behind. The reason is simple. Strength attracts attention. Attention creates participation. Participation creates more pressure. Pressure keeps movement alive, because creates effect. People see price rising and assume they missed the opportunity. Then they start hoping for a deeper decline. But hope does not create pullbacks. Markets create pullbacks when buying pressure temporarily slows or when selling pressure becomes strong enough to interrupt the move. There is an important difference there. Many traders are not actually waiting for healthy pullbacks. They are waiting for markets to become comfortable. And comfortable often never arrives. Ask yourself something. Why do inexperienced traders constantly try to short strong markets? Why do they keep trying to catch the top? Usually because strength looks excessive to them. It feels unreasonable. They see a chart moving upward and think it has already gone too far. But the market does not measure your feelings. A trend can stay stronger than people expect because strong markets feed on themselves. Buyers notice movement and enter positions. Other traders notice the movement and begin following it. Traders who sold too early start buying back positions. New pressure appears from multiple directions. Now the move grows larger. This is why many trends feel obvious only after they happen. During the move itself, people spend more time questioning it than understanding it. Strong trends do not usually hand out comfortable opportunities. They test patience. They create doubt. They force traders to ask difficult questions. Because markets do not reward comfort. They reward understanding of pressure. One of the easiest mistakes in trading is confusing a pause with a collapse. Traders see momentum slowing down and immediately assume the trend is finished. Price stops moving aggressively for a while, candles become smaller, and suddenly fear begins entering their decisions. They think something is wrong. But slowing down and breaking down are not the same thing. Momentum cooling is not the same as trend breaking. Think about a runner during a long race. A runner cannot sprint at maximum speed forever. There are moments where the pace becomes slower. Breathing changes. Energy gets managed. The movement continues, but the intensity adjusts. Markets behave in a similar way. Strong moves cannot stay explosive every moment of the day. There are periods where buying pressure relaxes or selling pressure loses speed. Price may stop moving aggressively and begin trading in a tighter range. Momentum indicators may drift lower. Traders watching only short-term movement often become nervous because they expect trends to move in straight lines. But trends rarely move in straight lines. Now ask yourself something. Have you ever exited a good trade simply because price stopped moving for a while? Maybe the market had been rising strongly, then suddenly it began moving sideways. You started thinking buyers were disappearing. Doubt entered your mind, so you closed the trade. Then a few hours later or a few days later, the trend continued exactly where it left off. That experience happens because many traders react to speed rather than structure. Speed changes all the time. Structure changes more slowly. This distinction matters because momentum naturally expands and contracts. Think of waves reaching the shore. Some arrive with force, while others lose intensity for a moment before another wave follows behind them. You would not assume the ocean disappeared because one wave slowed down, yet traders often do exactly that with markets. When momentum cools inside a healthy trend, price often remains above important support levels. Higher highs and higher lows may still remain intact. Selling pressure may appear, but not strongly enough to change overall direction. That is a pause. A trend break looks different. Structure begins changing, important levels start failing. Price behavior loses its rhythm. Buyers or sellers begin losing control. The market starts speaking a different language. Notice the sequence. Momentum often slows first. Structure changes later. The problem is that impatient traders rarely wait long enough to see the difference. They react to temporary discomfort. A few slow candles create fear. A minor pullback creates uncertainty. The mind immediately searches for danger because people naturally want certainty. But certainty rarely exists in markets. Experienced traders understand that healthy trends breathe. They expand, they pause, and they continue. Those pauses are not always signs of weakness. Sometimes they are signs of stability, because movement without pauses often becomes unstable. Controlled movement often lasts longer. Watch the structure before you fear the slowdown. Many traders begin with indicators before they even look at price itself. They open a chart and immediately shift their attention toward oscillators, moving averages, colored signals, and alerts. They search for a number to tell them what to do. Somewhere along the way, the chart itself becomes secondary. That creates a problem, because indicators do not create market movement. Price creates market movement. Indicators simply react to it. Price structure decides, RSI confirms pressure. That idea sounds simple, but traders often reverse the order without realizing it. They see RSI reaching a certain level and instantly make a decision before understanding what price is actually doing. They become focused on the tool and forget the thing the tool is measuring. Think about driving a car. Imagine spending your entire time staring at the speedometer while ignoring the road ahead. The speedometer gives useful information, but it does not tell you everything. It cannot show curves in the road. It cannot show traffic conditions. It cannot show obstacles. Price structure is the road. RSI is the speedometer. Now ask yourself something. If price is creating higher highs and higher lows, what does that tell you? It tells you buyers are maintaining control. It tells you demand is continuing to push movement in one direction. Structure itself begins showing a story. Then RSI enters the picture, not to replace the story, to support it. Suppose price is climbing steadily and pulling back in a controlled way. The structure remains healthy. Higher lows continue forming. Then RSI begins stabilizing around stronger levels instead of collapsing. Now something important starts happening. Price is showing direction. RSI is showing pressure. The two are speaking the same language. When those things align, traders gain information that matters. But when they disagree, caution becomes valuable. Imagine price pushing toward new highs while RSI becomes weaker and weaker. Does that automatically mean the market will reverse? No. This is where many traders become trapped. Indicators do not issue commands. They provide evidence. Evidence needs context. That difference matters because markets are built on behavior, not isolated signals. A single RSI reading without price structure can create confusion. A chart with structure but no understanding of pressure can leave important information hidden. Good trading often becomes a process of building a complete picture. First ask what price is doing. Is the market trending upward? Is it moving sideways? Is it creating lower highs? Is it losing rhythm? Then ask what RSI is revealing. Is momentum strengthening? Is pressure fading? Is participation becoming stronger or weaker? Because creates effect. Price movement forms the framework. Momentum helps explain what is happening inside that framework. Many traders search for shortcuts because shortcuts feel easier. They want one signal that removes uncertainty, one indicator that replaces judgment. Markets rarely work that way. Price speaks first. RSI responds afterward. Most traders believe good opportunities arrive with excitement. They expect strong candles, fast movement, and obvious action. They want the market to look alive. They want energy on the screen because energy feels convincing. The problem is that excitement and opportunity are not always the same thing. Markets reward alignment more than excitement. Think about what happens during highly emotional moments. Price begins moving aggressively. Candles become larger. Social media becomes louder. Everyone suddenly has an opinion. Traders who were not interested before start paying attention because movement creates attraction. Human beings naturally react to motion. Something moving quickly feels important. Something moving slowly feels boring. That instinct works in many areas of life, but in trading it can become expensive. Ask yourself something. How many times have you entered a trade simply because you felt you were missing something? Price starts running higher, and you suddenly feel urgency. You tell yourself the move is beginning right now. You become afraid of being left behind. Then you enter. A few moments later, price slows down or reverses, and you sit there wondering what happened. Usually the problem was not timing alone. The problem was emotional momentum replacing market alignment. Excitement creates pressure inside the trader's mind. Fast movement produces fast decisions. Fast decisions often ignore important questions. What is price structure doing? Who controls the market? Is momentum supporting the move? Where is pressure building? These questions become invisible when excitement takes over. Now compare that to alignment. Alignment is quieter. Price structure and momentum begin supporting each other. Trends show consistency. Pullbacks become controlled rather than chaotic. Indicators and price behavior start telling the same story. Nothing looks dramatic. Nothing feels urgent. That is exactly why many traders miss it. Because the mind often associates value with intensity. People assume important opportunities should feel exciting. But many quality trades appear ordinary at first. They develop slowly. They create little emotional reaction. There is no feeling of chasing, only observation. Think of building a house. You can place beautiful windows on unstable foundations, but eventually problems appear. Strong foundations create stability before visible progress happens. Trading works similarly. Price structure creates the foundation. Momentum supports the structure. Participation adds strength. When these elements begin aligning, movement often becomes more sustainable, because creates effect. Alignment creates confidence, because separate pieces of information begin confirming one another. Excitement creates confusion, because emotions begin competing with observation. Experienced traders understand something many beginners overlook. The market does not care whether you feel excited. The market cares whether buyers and sellers are behaving in ways that support continuation. Strong opportunities often feel calm. Weak opportunities often feel urgent. Most traders spend their time staring at the extreme areas of RSI. Their eyes immediately go towards 70 and 30 because that is usually where attention gets directed. They learn early that overbought and oversold levels matter, so they build their decisions around those numbers. Then something confusing starts happening. Price continues moving while those levels stop behaving the way they expected. They sell because RSI looks overbought, but price keeps rising. They buy because RSI looks oversold, but price continues falling. Eventually, frustration appears because the market seems to ignore the rules they thought they understood. But often the problem is not RSI itself. The problem is where traders are looking. The middle zone of RSI often reveals trend health. Now think about that for a moment. Most people search for extremes because extremes feel important. Extreme movement attracts attention. It creates emotion. It creates urgency. But healthy trends often reveal themselves in quieter places. Ask yourself something. During a strong uptrend, what happens after price pulls back? Many traders expect momentum to collapse completely. They expect RSI to fall sharply and reset toward oversold conditions. Yet strong markets do not always behave that way. Sometimes RSI pulls back only toward the middle area and begins stabilizing before pushing higher again. That small detail matters, because it suggests something underneath the surface. It suggests that selling pressure exists, but not strongly enough to take control. Buyers are still involved. Participation remains active. Pressure has cooled without disappearing. Imagine pushing a ball uphill. If your strength starts fading, eventually the ball rolls backward. But if enough force continues supporting it, the movement remains alive even if the speed temporarily slows down. Markets often behave similarly. Strong trends rarely maintain maximum momentum forever. They pause. They breathe. Energy expands and contracts naturally. During those pauses, RSI may drift toward the middle zone rather than collapse into extreme weakness. That middle behavior starts revealing information, not predictions, information. Now consider the opposite situation. A market moving lower continues producing weak rallies. RSI rises briefly, but struggles to maintain strength and quickly falls back. What does that tell you? It suggests buyers are trying to participate, but they are failing to sustain pressure. The trend itself remains healthy from the perspective of sellers. Notice what is happening. The middle zone becomes less about numbers and more about behavior. Many traders focus only on where RSI reaches. Experienced traders often focus on how RSI reacts, because reactions tell stories. Does RSI recover quickly after a pullback? Does it stabilize instead of collapsing? Does it hold strength while price structure remains healthy? Because creates effect. Healthy trends leave clues before continuation happens, and sometimes those clues appear where most people are not looking. Right in the middle. One of the greatest battles in trading does not happen on the chart. It happens inside the trader. People believe they are fighting the market, but most of the time they are fighting their own instincts. Human nature wants comfort. Human nature wants certainty. Human nature wants to feel safe before making a decision. The market rarely offers those things. Trend traders follow control, not comfort. At first, this sounds strange because comfort feels like the right place to stand. If a market has already moved higher, buying it can feel uncomfortable. If a market has already fallen sharply, selling it can feel uncomfortable. The mind starts asking questions immediately. What if I am late? What if the move ends right now? What if I am buying at the top? Those thoughts appear because people naturally want easy opportunities. They want the market to give them confidence before they commit. But strong trends usually behave differently. Ask yourself something. Have you ever watched a chart moving steadily upward and told yourself you would enter after a larger pullback? Then the pullback never came. Price paused briefly and continued moving higher while you remained on the sidelines. What happened there? You were waiting for comfort. The market was rewarding control. Control simply means one side is dominating pressure. Buyers continue absorbing selling pressure, or sellers continue overpowering buying attempts. The trend itself becomes evidence of that control. Price does not rise repeatedly by accident. Price does not fall repeatedly by accident. Movement continues because one side remains stronger. Now think about a tug of war between two teams. Imagine one side slowly pulling the rope in its direction. The movement may not happen all at once. There may be pauses. There may be moments where the rope barely moves. But the overall pressure still favors one side. Markets often work the same way. Many traders focus on temporary pauses and ignore who still controls the larger movement. They see a small pullback and assume the trend is failing. They see a brief rally in a downtrend and assume a reversal has started. They react to emotion instead of observing control. This creates a difficult cycle. Comfort usually appears after the move becomes obvious. By then, many traders feel confident because everyone around them also sees the same thing. News becomes positive. Opinions become stronger. Fear disappears. But comfort arriving late creates another problem. The opportunity may already be changing, because creates effect. Strong trends often feel uncomfortable because they challenge natural instincts. People want discounts. They want certainty. They want agreement from others. Markets do not always provide those things before movement happens. Experienced trend traders understand something important. Their job is not to chase emotional relief. Their job is to identify who remains in control and whether that control continues showing itself through price behavior. Comfort follows crowds. Control moves markets.